Hello, everyone who's coming in. I'm just going to wait a couple minutes just because we couldn't get that YouTube working. We'll figure it out. I'll get some help tonight and get that going. All right, so let me start sharing. Am I already sharing my screen? Let me see. No, I don't think I am. Start sharing my screen, and then we'll get the chat open. Okay, let's see. Hey, Tim. Hi, John. Okay. All right, guys, thanks for bearing with me. Like I said, I'll figure this out. Obviously, my first attempt at getting it to convert over to YouTube did not work out all too well. So I don't know where you all are coming from. I imagine that most of you are coming in from my services or from the publisher and are already familiar with me, but some of you may be coming in just straight from YouTube. And in that case, if you're not on my Telegram, there's the way to join Telegram. It's free Telegram, tradingpub.com/Kane, and you'll be able to join Telegram. I share all sorts of things. I'm not super active on Telegram, but I do what I can to keep you guys on the right side of the markets. For example, yesterday, I gave a lot of commentary on gamma levels, and it was actually really good guidance on exactly, actually it played out almost basically perfectly, where I showed very early in the morning, within half an hour after the market opened, I called out some levels. I said that the earliest indications were about 620 and 621, and that we had very little call and put interest, or it was kind of weak, so mostly chopping sideways. And then where did we close? We closed at 620.78, so that was pretty good, or 68 or 78, I don't know. I don't remember exactly which one. And then this morning I called out how, hey, we had early strength, but then the puts came in that was more of what I was expecting. And so I was expecting chop with no directional bias, but I thought it would be more flat rather than polar. And so what happened because of that, some wild swings and volatility is what I called out for. And what we got today was pretty much exactly that. So just swinging up and down, up and down, up and down. So those levels, those gamma levels are pretty accurate. They are very good predictors of what's going on in the markets. Of course, there's other ways, other things that we can look at to make it even more accurate. But if you want all of that in commentary, then you can sign up for the Telegram channel at thetradingpub.com/Kane. And of course, if this was on YouTube, then you could. There's someone else on here. Interesting.
I clicked my audio button, and all of a sudden, I think that's me, Kane. I'm sorry.
Okay. No worries. I didn't even know that you're able to unmute yourself. So
yeah, I mean, it was down there at the bottom. So I was like, what's that? And all of a sudden you said, hey, who's there? All right. Thank you, brother. Thank you.
Yeah. Thanks. Well, it's good to know. I'll have to, apparently there's a lot of things I need to fix in the setup. So I'll be sure to go over that tonight. So again, if Telegram channel, if you're not already on there, there's some good stuff on there. And then of course you'll be seeing some stuff from my publishing as well if you join that. Now, my plan for this is the aftermarket sessions. The aftermarket session, there is normally professional. So for those of you who don't know my background, I'm a former VP portfolio manager from PIMCO, $1.7 trillion asset company. I did touch all of the accounts there uniquely because the people on my desk, so it was me and 5 other traders or portfolio managers who managed short-term money market desks. And we were the only ones in the entire company that would touch every single account. And actually, me specifically, I would touch every single account. The other guys might if they were covering for me. But me specifically, I did touch every single account because of the products that I was trading. So I was trading repo, reverse repo. Well, we might talk about a little bit about that today and what it means in the overall context of the markets. I was trading agency, CP, short term, basically anything that was 2 years or lower was considered short term. But because I handled all of the overnight trades, that means I touched every single account because I would go in and invest all the excess cash that all the other portfolio managers left in their accounts. So if they only allocated 30% of their cash, they left 70% in just cash, and I would go and invest that overnight. So I ended up touching every single portfolio in that account. And that's why my trading volume is so huge compared to probably anything that you've ever heard of before. So about 200 billion per day. So that's where I'm coming from. That's my background. And this is where we're going to start drawing context in the markets based on all of that experience that I had on those desks. So you might already follow other people in the morning, pre-market, early in the market, late in the market. There's not a lot of guys who are doing post-market, so I thought I'd fill in that niche. One thing that you won't see me do, which is very important in the post-market process, is where we go in and review all of your accounts and portfolios. That's what professional portfolio managers do. So I can't do that because this is public and I can't just show you all the portfolios at the ones that I'm managing or in my services. But just know that that's what we do. And when we go in and we position all of our portfolios, we decide on if there's any hedges that we need to put on, and we start getting ready for the next trading day. But one of the most important things that we do is what we call marking to market. And basically, a professional portfolio manager will go through every single one of their positions and decide what the market value of the position would be. So tomorrow, if I had to sell this, if I had to liquidate right away, where could I sell this? Now, most of your brokerage platforms will give you a facsimile of that. Basically, they will give you, maybe I shouldn't show that one. Let me show you a very limited one. Okay. So for example, if in this one over here, the SPY, if you had these two calls in the SPY, a professional would go in and mark it. And so a lot of broker software will give you that facsimile and they'll throw in a mark for you, and it's always the mid price. However, that's not always a good price. That's not always a good mark. So in general, actually, it's a very poor mark, especially if the less liquid your asset is, the worse of a price the mid price is as an actual reflection of the value of that instrument. So some assets, SPY is super liquid, so you can see that this is only a penny apart. This is 2 pennies apart. So the mid price is a good approximation. But on something that has something really wide spreads, let me see, something I was looking at earlier, I think CBOE. Yeah, so if I look at this, that's the at the money option, and it is 75 cents apart on an option that is presumably about $2, $2.50. 85 cents apart is like 40%. It's huge. It's a huge difference between these two bid and ask prices. So if I just take the middle price, that's not a good estimate. So we want to just be aware that our broker software is going to mark our portfolio based on a mid price, and a lot of times it's not a good mark. So whenever people tell me they have an open position and say, oh, I'm up 2%, whatever, see P&L percent up 2%, I never, that is not, a professional would never do that. We wouldn't even look at that. But we would go in and mark our entire portfolio and individually go in and mark that. So like I said, I'm not going to show you that process, but I just wanted you to be aware that that is part of the process. So if you have a whole bunch of positions, you may want to mentally go in or actually physically go in and mark them for yourself. Unfortunately, no broker software that I know of for retail traders allow you to choose your own marks. So a professional will go in and mark, actually choose his own marks or her own marks, and actually put those prices in. And as retail traders, we don't have that option, so we can just kind of have to go with what is there. Okay, so one of the most important things that we're going to go through during this process is post-market process is figuring out there we go. Is a preparation going forward into the next day and getting a context. Now, you're going to update and refresh that context pre-market before the next session. But there's a lot that we can do in the aftermarket session in order to get ready for the morning. Okay, so you may already follow someone else's methodology for the morning process. So I'm going to show you my afternoon process. And I have my own morning process as well. But every professional will always, before the market starts and after the market closes, just get their bearings and just figure out the overall market context. Now, I don't know if any of you have any of you taken upper division math in college, upper division? So beyond calculus. Maybe this is a terrible example. Maybe I shouldn't be using this as. Okay, so if we think about math, most people think about math as immutable, indisputable, that it is, the numbers don't lie. We hear that all the time. 1 + 1 = 2. 1 + 1 = 2. The numbers don't lie. That is mathematically proven. It is what it is. You cannot dispute that 1 + 1 = 2. However, if you ever go into upper division math, what you will find is that that's where you start. I'm sorry, if you go beyond lower division math, then basically every single class is about proofs, what we call proofs, where you go through and you have a theory or a statement, and then you go through and you start proving it mathematically. But the beginning of every proof starts with the assumptions. It always starts with let X be the realm of real numbers. Something like that. Assume blah, 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 blah. Let this blah, 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 blah. It is always a set of assumptions, and then we go and we prove a whole bunch of facts once those assumptions are in place. And the market and actually life is the exact same way. For example, I just said 1 + 1 = 2, and no one here is going to argue with me that 1 + 1 = 2. However, when we say that, there is an underlying assumption that none of us addressed, which is that we're talking about real numbers or whole numbers or some subset of the real numbers. Or because 1 + 1 does not always equal 2. That might sound weird. Hi, John. It might sound weird that I'm saying that 1 + 1 doesn't always equal 2. But for example, in the realm of binary numbers, 1 + 1 doesn't equal 2, right? Because you only have 0 and 1. In the realm of binary numbers, you only have 0 and 1. So 1 + 1 cannot equal anything other than 1 or 0. So 1 + 1 is actually 0 mod 2. Okay, so if I don't give you the baseline assumptions, we cannot accurately evaluate whether a statement is true. And the market is the exact same way. If we don't find out the underlying assumptions, the underlying context, then anything we do after that might be proven completely false and meaningless. So normally when I say 1 + 1 = 2, it's a pretty good assumption that we're talking about real numbers. Very few people walk around this world talking about imaginary numbers or the binary numbers or other realms in which 1 + 1 might not equal 2. But so it's a good assumption. But if we just blindly make that assumption, we'll be right some of the time, and then we'll lose our shorts and lose and blow up our accounts in those instances where we're wrong, where the assumptions were not correct. So getting the context of the market is absolutely important. Okay. Now, if at any point in time anyone has any questions, or if you guys want me to cover something, just throw it into the comments, and I will be more than happy to go over it. The only thing I won't go over in these sessions are trades that are inside of my services or positions that are inside of my services. And of course, I won't be giving advice. Okay, so I operate under publishing exemptions. So I can't give advice. I can't, advise you on your positions. I can give trades. So I might give certain trades, but they have to be published trades. I have to tell everyone about the trade. So I can't just say, oh, your specific trade, things like this. So you may see me give you some bonus trades every once in a while, but I can't comment on specific trades. I can teach you about everything else. Is that what you mean when the mid isn't real? When I mean the mid isn't real was actually what I started out saying was when professionals mark their positions, anything that cannot be transacted upon isn't a real price. So this 185 guarantees a transaction. 260 guarantees a transaction. $2 does not. 215 does not. I don't know what the mid is here, 37, so probably about 225, 227-ish is probably the mid. Or 222 and a half is the mid right here. That's not a real price. If I go in and say, hey, I want to buy at 222.5, I may or may not get it. And if I say I want to sell at 222.5, I may or may not get it. It's up to the market maker if they want to transact. So that's why it's a false price. And you will never see 222.5 on any of your statements. At the end of the month, or if you go into transaction history, that 222.5 will not show up unless you happen to be able to transact at that price. And that's what I mean by mid prices are not real. All right, so the wider the spread is, the less likely that you'll be able to transact at that mid price, and the more made up that price is. Okay, so that's what I mean by it's not a real price. Yeah. Hi, Scuba Chris. Okay, so what I'm going to do every day is you'll see me repeat this process over and over again. And this is how I get the context of the market that I'm operating in post-market. And like I said, in the morning, it's a slightly different process. But you probably already follow someone else for that. Mid-price is just an average of the bid and ask. Yes, that's correct. Bid price is always halfway in between the bid and ask. That's correct. The mark in retail traders, brokerage softwares tends to be the mid price. So that mark is not necessarily a good mark. Okay. All right. So first thing that I need to decide is basically why go through this? Why go through God? What's the basic underlying question that I'm trying to solve when I open it? I say, hey, let's see what the market today. What everyone does is, okay, let's take a look at SPY. Let's take a look at QQQ. Right? Looks like take a small caps, but the default is usually SPY. And what are we trying to answer? Some people will say, oh, well, I'm trying to answer, is the market going to go up or go down or whatever? And that's a little jumping the gun a little bit. The most fundamental question that any portfolio manager is trying to answer, and you are the portfolio manager of your own accounts, so you should be trying to answer this as well, is number one, is this market environment favorable for me? That's it. Because if it's not favorable to you, then there's no point in doing anything else, right? They're like, oh, who cares if it's bouncing off the MA50 or whatever, or it's a perfect whatever setup, or you're seeing this head and shoulder, whatever you're looking at, or that insiders are buying, or there's momentum, or whatever you're looking at, or whales are buying, or this senator bought this stock, or what? Who cares if the market is not favorable? So we always need to get that context first. And that's the question that we are asking. Now, the more versatile of a trader, the better, the more knowledgeable, and the more strategies that you have under your belt, then the more likely it is that the market is favorable, the conditions in the market are favorable for at least one of your strategies. Okay, so a lot of people think that you have a bull strategy, you have a bear strategy. Some a little bit more sophisticated traders will have a sideways strategy where there's no particular directional bias. And those are the three most fundamental and basic. But it's too basic. That by itself is just because the market is going up doesn't mean that it's favorable for a bull strategy. And we'll get into that. And the more you see me do this, the more you'll start understanding that. So how do I determine whether or not a market is favorable to me? So I don't know if let me go through the whole the process first, and then I'll start picking apart, because it's going to take me more than just the 30 minutes that we have left for me to explain every little detail. And this is going to be ongoing every day, basically in perpetuity. So you'll be able to see the whole process, or I'll be able to have plenty of opportunity to explain the details. So basically, the question I want to answer is the market favorable for me? Or, given the current market conditions, what strategy would this market be favorable for? So it just depends on how sophisticated of a trader I am. So I need to figure that out. The very first thing that I'm going to look at is VIX. If I'm looking at this market. Now, again, like I said, in the morning, it's different. I'll look at different things. But after markets, the first thing I'll look at is VIX. What did VIX do today? And basically, it didn't do much. It went from 17 something to 16 something. It dropped from maybe 50 points. So that's not anything significant. This might have been a significant. On most days, VIX is not going to do something significant. Some days it'll spike way up like this, but in a lot of environments, it just kind of chops sideways like this. But I want to know that, because the way that I trade when it's doing this is very different than on a day where it's doing this. Okay, and I think you guys can get a feel for that. Obviously, if VIX is shooting through the roof, then the way that I trade is going to be very, very different. The types of trades I do, the amount of risk that I'm taking during that time, the way that I set stop losses, all of it is going to be completely different. And that is why I start with the VIX, because the VIX environment, the volatility environment, absolutely changes. It is a huge determining factor in my behavior as a trader or portfolio manager. Okay, so right now I'm just looking at VIX, and it's at 16.8. And if I look in the context of recent history, that's nothing special about it. That this is kind of the region that we expect it to be in ever since July of last year. Before July of last year, we actually would have expected to be even lower. But at least from July of last year all the way till now, this is normal. All right, so if this is normal, if this is considered low volatility, then that is the first step in being favorable to me as the average retail trader, or what that tells me as a trader who is a bit more versatile is I can use the types of strategies that I normally use. I don't have to switch up my strategies. So under 20 is relatively low risk. And we can see, since as far as I can stretch this thing, the vast majority of time, this blue line is 20. Okay? The vast majority of time we do stay below 20. There's only certain market environments where that volatility is above 20 or consistently stays above 20. Okay, so for me right now, we're below 20, it's 16.8. This is good. It also tells me that in a low volatility environment, I can expect trends to hold. If it was a high volatility environment, who knows? So now this depends absolutely on your time frame. I happen to be looking at a daily time frame because if I looked at the volatility today, then what we would say is that this was a reasonably high intraday high volatility with zero directionality, just chop sideways. But it did kind of swing a bit. I mean, in the grand context of the SPY, it didn't swing a lot, but in the context of minute by minute, it did swing quite a bit. Same with this, same with this. So if I know that I'm in a low volatility environment, that means to a professional money manager or asset manager or portfolio manager, however you want to call it, it's a risk on environment. I can take risk. I can put on trades and I have a reasonable expectation that they will play out a certain way, that they will follow trends. If I follow trends, then what kind of trades do I want? I want trend trades, but what kind of trend trades? Do I want to buy pullbacks or do I want to look for breakouts? What do you guys think? Any ideas out there? How many people do we have here? Okay. Pullbacks, exactly. Yes, Scuba Chris. Yes, exactly. Why? Because your highest probability trades in a trending environment are when a short-term trend reverses to match the direction of a long-term trend. What do I mean by that? Let's see if I can find a cleaner chart. Let's go to clean. There we go. Let me get rid of these lines. Okay. So let's just choose something that will indicate a short-term trend. Okay, so I'm just going to choose the 8-day EMA. Okay, and then I'm going to choose something to represent a longer-term trend. And for that, for now, let's just choose the 50 EMA, okay? So over here, if I look at this purple line, that's the 8 EMA, that's my short-term trend, and the green is my long-term trend. So my highest probability trades in a low VIX environment is when that short-term trade reverses direction and starts going in the same direction as the long-term trade. The long-term trade was just doing this, okay? So reverse direction and follow the long-term trend, okay? So this, from here to here, that was a high probability trade right there. Now over here, it goes and it crosses below, and then the long-term trend reversed direction to match the short-term trend. That is not a high probability trade. That's a very different type of trade. And I will guarantee you that the VIX environment right here was not the same as the VIX environment over here. Let's look at that. That's about March 2025. Okay. March 2025. See? We're above 20 in that environment. Okay, so I'm not looking for trend trades in that environment. Where did it go? Over here. Okay. But then what happened again over here? This short-term trend reversed against the long-term trend. The long-term trend was flat here. This one is going up. And then again, what happened was the long-term trend shifted to match the short-term trend. So what you'll notice is that oftentimes when it's the low probability event, which is the short-term or the long-term trend changing to match the short-term trend, that is often marked by a volatility regime change. All right, so let's look at May over here in the VIX. May and VIX, all right? Mid-May VIX, we dropped right back below the 20 and basically stayed there. There's a couple times where we popped above, but that was the time when VIX actually broke below 20 and stayed there. So we had that regime change over here to above 20 VIX with a couple of days exceptions, but we started and we went way up. And then we had that volatility regime change in mid-May back down below 20. And both of those were marked by what we just said, which was the, where did it go? All right. So the long-term trend shifted to match the short-term trend instead of the other way around. Those are not high probability trading events. The high probability trading events are like this one, where the short-term reversed to match the long-term trend. And then over here, these are just very baby pullbacks because it's been very strong. But you can see that there's that dip down in the EMA 8, the dip down in the EMA 8, and then it reversed to match the long-term trend. That's a high probability trade right there. And then this is a high probability trade right here. Okay, so let me mark the high probability trades. So this one was a high probability trade. This one was a high, come on. That one was a high probability trade. That one was a high probability trade. Okay, these others were not. And let me ask you, if you were trading directionally during these low probability trades, was it a hard time? Was it difficult to trade during that time period? The answer is yes. Probably because you were trying to do a trend following strategy when it was not the appropriate environment to trade a trend following strategy. So in my services, in the trending trades, which are Quant X and Gamma Pockets, I issued very few trades during this time period. And people were wondering why. It's because exactly what we're talking about right now. I know my colleague Roger Scott, he was issuing very few trades during this time period also. The people who are issuing trades during this time period, if they were using trend following systems, they were getting their butts handed to them. Their win rates were very low during this time period. Okay, so I think you guys can probably experience that. So now you have a greater context to understand why. So if we go back a little bit further, this is the long-term trend, and then there's a great high probability short-term trade, right? The short-term trend reversed to follow the long-term trend. And then it did it again right here. Or you could split that into two if you wanted to and say, okay, there's two interesting possibilities right here, or one long one, depending on how sensitive you are. But if we're using the EMA 8 and EMA 50, then yes, these would be two separate ones. Okay. So the very first clue as to whether or not this is a favorable environment for me is looking at my volatility VIX, my volatility regime. Okay. And any questions? Are you guys learning something so far? Have you guys ever heard this before? Just curious. I mean, obviously I'm not the only person in the world who knows this, but I don't think many people talk about it, or at least to retail traders. And the people who are in the retail space, most of them probably don't even know this. Never heard it before. Yeah, this is great. Oh, good, thank you. Heard it, but it never hurts to hear it again. Okay, great. Learning new to me. Roger has said it. Okay, great, good. Yeah. So I put a lot of emphasis in looking at my volatility regime. It's not. I know I've seen Roger take a look and say, "Oh, VIX is below 20," but I've never heard him expand on it or say why he's looking at that. So, but I could be wrong. I'm not listening to what Roger says every day. So right now, what we're noticing right now is that we moved up in the S&P, and if we call this a pullback, I should use a different tool. Path, here we go. So that's a pullback. That's a baby pullback. And this, can we consider that a pullback? It's only been 2 days, maybe. Okay. So what we need to find out is is this it? Is that the actual pullback? Which would be not really much of a pullback at all, which would indicate a very, very, very strong market. Or is this the beginning of something that pulls back a little bit further? Okay. Maybe all the way to that EMA 50, maybe to something in between like an EMA 20. And then, or if it becomes a weak market, then it'll break that EMA 50 or MA 50. But so far, the market hasn't given us any reason to believe that it's weak. There's plenty of strength, plenty of signs of strength in the market, very few signs of weakness in the market. Pullback is not a sign of weakness. It's just a natural rhythm. But if you were in my Telegram channel yesterday, I said that I would have a lot better risk appetite if we got to 610 or 60, sorry, did I say 610 or 615? Let's see. Okay. Yeah, 615 or 610. I said I have a lot more risk appetite. Why? Because I'm looking for that change. I want to see that short-term trend stop matching the long-term trend and then change back to the long-term trend. That's my high probability entry. And so if it is just going to pull back to this EMA 8 and then bounce, then that's it. Then I'm good to go for entries. But if it's pulling back even further to a 610 or maybe even 600, then that's even stronger conviction, because that's a deeper pullback. When it finally reverses, that's the high probability event. So right now, to go into any sort of opportunity is somewhat. It could be this, if the market is super strong and this is close enough to a pullback to the EMA 8, then it'll just go from here. If it's not, if it's more normal, then it might do something like this. Well, this is slightly weaker, where it pulled back, that's probably EMA 20. Let me just throw that, or 15. Some people use 15. Okay, so yeah, that pulled back perfectly, almost perfectly to the EMA 20. This pulled back perfectly to the EMA 20. Okay, so the EMA 20, it caught both of these short-term trend reversals. So that's what I'm looking for high conviction, high quality entries. I'm looking for that pullback, then reversal to match the longer term trend right here. So right now, tomorrow entry, is that a favorable environment for a trend following system? The answer is if it bounces from here and goes up, then yes. If not, then I've got to wait to that EMA 20 or EMA or MA 50 in order to find that reversal of trend, reversal of short-term trend to match the long-term trend. Why? Because we are in a low VIX environment. We'd be having a completely different conversation if VIX was above 20, or if VIX was above 30, or if VIX was above 40. Okay, but since right now we are below 20, this is the conversation that we're having. Is the market condition favorable for me to utilize my trend following systems? So the second thing that I want to see is signs of risk taking by real money, by institution, not by retail traders, not by mom and pop, by real institutional money. And what are some signs of risk taking by money managers? One is one thing that you'll learn to follow if you keep watching me is ratios. I was looking at ratios all the time when I was at professionally managing money. Ratios. It was always about ratios. It was never, where's gold trading? It was always, what's the gold-silver ratio? What's the gold SPY ratio? What's the SPY oil ratio? What's the SPY TLT ratio? Okay, it was always about ratios. It's always about this asset relative to this asset. Why? Because as a portfolio manager or money manager, asset manager, you are always looking to put your capital where it can gain most efficiently and for the risk that you're taking. So what are some signs? And maybe we'll show you something that maybe a lot of you didn't know that TradingView could do, but I can do SPY divided by gold. That looks very different than SPY by itself, or SPY US dollar, right? This is basically SPY US dollar. So if I do SPY US dollar futures, it's the exact same chart, right? It's basically looked the exact same. It didn't really change. Right? I'll pull it back to SPY. See, it didn't change at all. But suddenly, if I do SPY and compare it to gold, I go, oh, well, it has been recovering since April, but it is not even close to all-time highs. All-time highs were all the way back here in 2021, not even in 2024 or 2025, earlier 2025. That is interesting to know. Right? So in this context, if you were a bull, a market bull, a SPY bull, you would say, oh, there's a lot more room for the S&P to go higher in terms of relative to gold. And I'm still well below these moving averages. So in terms of gold, SPY is still in a bear market. And it's been in a bear market since the beginning of this year. Oh, that's a very different picture than when I look at SPY US dollar, right? So what has gold been doing? It's been shooting straight up. That is why that looks, the ratio in SPY gold looks the way it does. Because gold has been on a ginormous bullish run that SPY simply hasn't been. And so if we are worried about in terms of like flight to safety, pricing things in context of gold can give us a lot of insight. And we can see, okay, well, what if I see gold starting to be no longer favored? So because this has been an amazing bull run, we had a couple areas where we chopped sideways, and this is another chop sideways period over the last month or so, 2 months actually, maybe even 3 months, 2.5 months looks like, which is a little bit longer than this one and a little bit longer than this one. So that gives me some information, and I want to know, is this potentially a market top for gold, a local top, right? So where it might pull down like this, because if it is, then when I look at SPY gold, what that should mean is that this, if SPY does nothing and gold drops, then this is automatically going to go up. If gold drops and SPY goes up, this is going to go up really fast, which means that, hey, maybe this might be a bullish period for S&P. Okay, I can do the same thing for SPY TLT. SPY TLT is definitely at all-time highs, even more so than just SPY US dollar. And so the classic example is the classic portfolio is stocks and bonds, a balance of stock and bonds. And when you're risk averse, you shift more allocation to bonds. And then when you're more risk taking, then you shift even more money back into stocks. That is starting to get a little bit outdated, but there are still plenty of institutions and portfolios that are still built upon a balance between stocks and bonds. There's these old stock like pension funds and like stodgy institutions who don't like to change what they do, and that's still in effect. So this is an indicator to me, SPY versus bonds, that actually, yes, we are in a risk on environment, but that could also, I have to be very careful here because that could also be a reflection for one of the first times in history of an aversion to US bonds, to the point where companies look more enticing than the government does. Okay, so I've got to read a little bit more carefully into this ratio than I ever had to in previous times in history, because for the first time we are seeing people kind of shy away from US bonds, and we've lost AAA rating at all three agencies at this point. United States bonds have. So we can't treat this ratio the same that we used to, because when everything was AAA and the US was the definition of a risk-free rate for the world. It still is, but not in the same way that it used to be. Okay, so I want to see signs of risk-taking. I am seeing it in SPY TLT. I am seeing it in SPY gold, although not nearly to the same extent. Like what I'm seeing is this recovery and this trend and this move upwards. And then what will be very important is when we hit that MA200, if it breaks through, if we revert back, that'll be very, very telling. Okay, you could even do things SPY Bitcoin. Let's modernize ourselves a little bit. You can see that SPY Bitcoin is just not doing that well. Never has. But what we're seeing is it's not falling down any worse. It's flatlined over here. And potentially, if we start seeing, we are very flat right now. If we do see a break above that MA200, we could start seeing a favoritism on stocks over Bitcoin. We start seeing this go up. Now, if we see Bitcoin going up at the same time, like a lot of people are still very bullish Bitcoin, if we see Bitcoin going up, but we see this ratio going up also, that means that SPY is growing faster than Bitcoin. So that would be a super bull market in SPY. Okay, so I'm not really seeing this. This isn't giving me too much information right here, But at least so far, what I see in SPY GLD, cautiously optimistic that there is risk taking happening in this market. And if I look at SPY TLT, for sure, we were saying, oh, well, for sure, we're favoring stocks over bonds at this particular moment in time. And that could continue to happen if US dollar keeps deteriorating and people keep not really wanting US bonds, then that is actually favorable for US stocks. Right? So I am seeing some signs of risk taking, which is good. In my that is making it a favorable environment for me to go long stocks or follow trend following strategies in the S&P 500. So far, the volatility environment, it says, yeah, go for it. The risk taking that we're seeing in the markets are saying not super great, but not bad. So yeah, it's probably pretty safe for you to go into it. And then the third piece of it, and then we'll wrap it up for today, is that I'm going to look at participation, market participation. So Jesse says, great insight comparing SPY to other assets. Yeah, that's the professional ratios. It's all about ratios with institutional money managers or Wall Street. Okay? Yeah, and then a bit over my head, how do we know if it's in a good environment? If what is in a good environment, Carla? So basically what we're doing is trying to figure out if this is a good environment for us to trade certain strategies in. And so we've decided that VIX is low, below 20, and that is favorable for trending strategies, trend following strategies. And then we just went through all these ratios and say, yeah, there's some signs of risk taking in the markets right now. So that is also favorable. So far, 2 for 2. And then the last thing that I'm going to look at is market breadth. How wide is the participation in this market? Because if it's very wide, that is definitely positive. It's very narrow, that is far less positive. And it means I have to pick my stocks super, super, super carefully. For example, if chip stocks are the only things going up, I better be in chip stocks. Right? If everything else is just doing nothing or even falling, then the only way I'm going to make money is if I'm in chip stocks or something else. If the only thing that's going up is healthcare and everyone's running away from technology, I better be in healthcare if I'm going bullish. Or if I'm going bearish, then maybe I'll want to be in tech, right? So market breadth is very important. The way that I have my own chart set up is right here. So I look at this S5FI index, S5TH index. These are the number of stocks trading above their 50-day and 200-day moving average. I believe a lot of you who follow Roger are more familiar with it over here in Momentum, excuse me, where you can see the percentage of stocks in different sectors or in an index that are trading above their 50 and 200. So this is very similar to what I was talking about earlier. Short-term trend versus the long-term trend, and reversing and reverting. Okay, so if I start to see something like this, where I've got 82% on the 50 and 63 on the 200, my concern is going to be that this is going to start turning, because the max it can go is 100%. Look at this one, 91%, 78%. The max it can go is 100%. So once it hits there, is it going to stay there forever, or is it actually ever going to hit 100%? Very unlikely. So once we start getting to these high numbers, then what you're going to expect is that this one is going to reverse. In this case, it's going to reverse to go the opposite direction of the longer term trend. And that's going to tell me that I am no longer in a high probability environment. Why? Because the highest probability was when the short term first turned to change to match the long term, and then the continuation was riding that up. They're both moving in the same direction. And then this one, communication services, look at that, 91%, 78%. My concern here would be, this is so close to 100%, this might start moving downwards. And if it starts moving downwards, this is pretty high as well. And I might turn into a situation where that long term turns around to follow the short term, which we saw a little bit earlier, and which we said was kind of a sign that we were changing volatility regimes. So this is flashing a warning sign to me. Communication services is flashing a warning sign to me. Materials is different. Materials is very high, but the 200 is just right in the middle, 50%. So this could easily fall back down towards 50% and not drag the 200 with it. And so it can go down and meet or get closer to the MA200, then turn around, and then we would have a high probability event again, where the short term starts to increase and match the same direction as the long term. Okay, so I want to look at that market breadth and see what it's doing, especially in the indices, but in the sectors as well. So if I look at the S&P 500, I've got 72% above the 50-day moving average, 58% above the 200. This is not extreme. This is not super extreme either. And I can see that in my chart, right? So we can see the red lines kind of mark extreme values. You can see that basically anytime we reach that red line, it can't stay there for long. It starts reverting back down. And we're not quite at the red lines in the MA50 yet, and we're far from it from the MA200. So what that tells me is it reaffirms what the volatility regime affirmed for me, which is that if I do start seeing a downturn in the MA50, it's not time to panic yet. It's not time to say, oh my God, we're going into a bear market. What we're most likely going to see is that, yeah, it'll come closer to the MA200, but more, unless it just completely crosses over, more likely that we're going to bounce and go up for another leg, and that'll be another excellent entry point into the markets where we can go long a whole bunch of different trend following strategies. Okay, so everything that I'm seeing so far here is favorable. It's bullish, it's favorable or mildly favorable. So that gives me the context to say, okay, well, everyone and their mother, including Kane, is saying that we need a pullback. This has gone up too far. We need a pullback. We need a pullback. Well, maybe not. Maybe we just need to chop sideways for a little bit. And then that would be so if this EMA 8 goes flat, that and then moves upwards, that is also the trend changing to match the longer term trend. It doesn't have to go down against it and then trade against or match the trend. Okay, so that's the environment that we're in. So this market is looking so strong that it is entirely possible that this could be the pullback, right? All I'm waiting to see is, does that EMA 8 just kind of flatten out and then go back up? In which case that would be a reversion of the short term to match the long term, and then it'll be risk on again. Yeah. So that's what I'm looking at in the markets right now. Any questions before we end this? Okay. All right, guys. So we're, like I said before, we're going to be doing this over and over every day. You're going to watch me do this. You're going to, so in real time, you'll see when I evaluate, oh my gosh, things are changing. And maybe it's not favorable for a trend system anymore. And then what type of system would it be favorable for? Okay. All right, guys. So hopefully this was a good start to our post-market stuff. Thanks for joining me. Sorry about the YouTube snafus. I'm going to have to figure that out for tomorrow. All right. Bye, guys. I'll see you tomorrow and have a great rest of your day.